absolutely flat, 8 or 10 point change, but higher, 19,654 on the index. Another company which is reacting to numbers in a very large way is DCB Bank. I mean, the stock is down, I think, 5.5%, 6%. Numbers have been a little mixed. So while loan growth and deposit growth, etc., have been pretty decent, slippages have gone up. And recoveries have been a little poor. That's basically led to gross NPLs rising. We also have margin compression of some 35 basis points on a quarter-on-quarter basis. So let's actually get the management in to address some of these issues. Mr. Murali M Natrajan is Managing Director and CEO at the bank, and he's with us. So Mr. Natrajan, good to have you with us here. Thank you very much, sir. Could you explain to us, could you start with margins, first of all? It's a 35 basis point compression. What are we to expect for FY24?
So, we have built the business model, and I've been guiding this for quite some time, at a margin of about 370 to 375 basis point. This quarter, our margin is 3.83. So I can argue that our margin is still higher than the business model that we have created. Cost of funds have been going up since, I think, almost October. The methodology works like this, that when EBLR is changed based on repo rate changes, cost of fund takes a little time to catch up. In more recently, cost of funds have not been raising so fast. So I don't expect similar kind of compression in our margin, and we should be able to hold on to our business model NIMs. More importantly, most of our portfolio is repriceable portfolio. So therefore, even if the cost of funds goes up, I don't believe that our margin compression would be severe. So we should be able to sustain with the product mix and the cost of funds mix at about 373-75 basis points.
Okay. The business momentum has been quite steady, Mr. Natrajan, and that's good to see. Of course, the entire industry is picking up pace now. But what kind of deposit and advances growth are you looking at for FY24?
So we don't give guidance on a yearly basis, but the kind of frontline investments we have done, including the number of branches that we have added in the last 1 to 2 years, and the kind of products, plus the process improvement, the technology that we are putting in, we believe that we should be able to double our balance sheet every 3 to 4 years. That is the kind of momentum we are building. Our deposit growth has been about 22%. Our loan growth has been at about 19%. But if you look a little deeply, the core products like mortgages, home loan, co-lending, construction finance, agri-inclusive banking, which is our core business, has grown at higher than 20%. So we expect this trend to continue. There is a reasonable amount of demand, and we are putting in more efforts in terms of expansion as well as increasing our frontline. So that should help us to continue to grow our balance sheet and deposits and loans.
Slippages were higher in the quarter, I think about 4% as compared to 3%, the quarter-on-quarter comparison. Could you tell us what happened and what should we expect going forward?
If you look at our collection efficiency, there has been a slight drop in April, and when we look at more details, it seems to be a slow first quarter, also number of holidays in April, plus some weather interruptions in the north. All that put together has given us some kind of a lower collection efficiency in April, which we built up by May and June. If you look at our June collection efficiency, we are pretty much back to normal. The recoveries and upgrades is where we had a little bit of slowness, and we are building pipeline of recoveries and upgrades. If you look at whole of last year, our recovery and upgrades were almost 100% of the slippages. And I believe that in the next 1 to 2 quarters, we should rebuild the momentum in recovery and upgrades while slowing down the NPAs. We don't see any fundamentally any issues with our portfolio. And I also want to say that more than 85% of our portfolio is secured business. Therefore, the loss given default continues to be well within the range that we have kept in our business model.
Your cost to income ratio has been around that 64% mark in the quarter gone by. Can you give us some guidance on that as well as on the operating efficiency?
The target cost income ratio is about 55%. The target cost to average is assets about 2.4, 2.5%. It will take us some time to reach there. I want to say that we are a pure retail SME business, so we don't do much of big ticket business. If you look at the market, whichever banks are in largely retail and SME business, you do see cost income ratios at 58 to 63%. So I don't think we are too different from that. Having said that, through technology, process improvement, and also because of the growth that we are likely to achieve for the investments we have made in the last couple of years, we expect cost income ratio to come down step by step.
Got it. Mr. Natrajan, on asset quality, would you like to leave us with a guidance for the year? Where would you want to be, or where would you be?
We don't give yearly guidance. If you look at the target that we are setting for ourselves is 2.5% on GNPA and 1.25, 1.5% type of on net NPA. Over time, we should do better than that. If you look at the pre-COVID, our business model, we were at about less than 2% on gross NPA and about 1% on net NPA with a strong provision coverage, which continues to be so. So our intention is to steadily move towards that direction, and that's where we are working towards.
All right, we will let you go on that note. Thanks a lot for joining in. Appreciate your thoughts. That's DCB Bank. By the way, the market is so quiet, not too much happening. Just a couple of these power